Hey, this is Nick from Income Digs. Welcome to this video tutorial where we show you the exact tools that we use to run our real estate investment business. Today's video is a follow-up and the closing video for the series of real estate accounting. Today's video we're going to demonstrate how to sell a property and account for it in your bookkeeping system. We're going to use QuickBooks like we've done in the previous episodes. If you haven't checked those ones out, I recommend you do so. It's going to help you get on board with exactly what's going on here. All right. So today we're going to talk about how we take the closing statement of a sale and we put that into our accounting books. We're going to zero out the balance of our fixed assets and we're going to pay off a loan. And ultimately, we're going to get a check. All right. So we're going to demonstrate exactly how that works. So looking over here at my balance sheet, just bring everybody up to speed. What I've done is added another few transactions to finish my improvements. Okay, so now you can see that the total for 123 Main Street is up to $175,000. That's my basis. $100,000 purchase, $75,000 in improvements. Okay, I've also zeroed out my escrow account, meaning that I've gotten it from the bank and it's gone to my checking. The loan still remains at $125,000. Now, it's possible that throughout the year I was making payments on that and the principal could go down, but it's also possible that I was making interest-only payments and the principal stays exactly how it is. We're going to make that assumption as we move through this video. All right, so what we need to do is really just make one single journal entry that will take into account this year closing statement. All right, now it's one single journal entry, but it's a pretty complicated one, so let's talk about it. Let's look at the closing statement for now. First, we have the basic info up top. Now, let's assume I sold this property for $235,000. So on the surface, that's nice, a nice little profit, right? So that's cool. Let's break it down. So what you'll see on your closing statement is often this section where they're doing some prorated charges, either additions to the sale price, meaning that the buyer owes something to the seller, or credits to the purchaser, which is the opposite. And it's usually surrounding taxes or water bills or something like that. Something where you pay up front or you pay after the fact and it should be prorated. Okay, so in this example, the city tax and the county tax, I've already paid them, but there's going to be days throughout this year that I don't own the property, so I should be due back some of that. And on the contrary, we have one that the purchaser is going to pay, but I've enjoyed some of that use throughout the year, so I'll owe them on that. All right. So your attorney will figure that out and put that onto the closing statement. And then, so this is how much the purchaser needs to come to the table with, which is awesome. That's great. But then the disbursements will lay out as such. So I have to pay off my loan, $125,000. I got to pay my realtor commission, transfer tax, office costs, survey update, search, all these other fees. Okay. So basically, when all of that is said and done, that's $141,000 worth. The net due to me, the seller, is going to be a check for $93,264.90. All right. So we're going to show you how we can make that happen in QuickBooks and get this thing sold. All right. So we're going to go in and do a journal entry. Now, the trick to these journal entries I've found is to start with the easy stuff. Okay. And the easiest thing for me is this net due to seller. So I know that all of this is going to go in and out, debits, credits, whatever, but I know that at the end of this, I'm going to get a check for that amount. So I like to start there. So Income Digs checking will get a debit of $93,264.90. Okay, that's an easy one. What are the other easy ones? Well, in my opinion, balancing out or zeroing out our fixed asset accounts are pretty easy. So 123 Main Street, the building, as I sell it, I'm going to credit that account the amount of the balance. So it's worth $100,000 per my books. So I'm going to say it's gone. Okay. And I'm going to credit that amount. I'm also going to do the same exact thing with the improvements. Okay. The capital improvements, they're worth $75,000. So I'm going to zero those out. As I sell this property, my basis is a total of $175, so I'm going to credit that from my books. All right, another easy one is the loan. So we owe $125,000 to the bank. Okay. So the loan, we're going to debit $125,000. All All right, so we got a lot of the big ones out of the way, and now it's time to really dig into this closing statement and break it down. So I'm going to start at the top and work down. So we have some property taxes here, okay? So my property taxes, now they're going to be credited to me. So I'm going to lay those out. $149.04 is for the city tax. We have $384.71 is for the county tax. Okay, now I owe the purchaser property tax. So again, I'm going to use property tax as my account, and in the debits this time, $593.85. All right, and this is for school tax. So I'm trying to almost mirror the closing statement on this journal entry. All right, so now let's go through the disbursements. I already took care of the loan payoff, so let's do the rest. Realtor's commission, I'll put most of these under professional services. You might want to break these out if your reporting needs are such. So $14,100, and then I'd like to, again, to mirror the closing statement, I'll use the exact verbiage of the attorney. That way I can tell that they match up. All right, the next one is transfer tax. And then we have office costs. And then we have a survey update. And all attorneys do this differently, so you're going to get used to how your attorney's closing statements look, but ultimately they just do the same thing. Search continuation, and one more for $10, which is file gains tax affidavit. All right, so we're almost done, but we're not balanced here. And why is that? Well, it's pretty simple. We made money on this deal, okay? So we made some money. We sold it for $235, and our basis was $175. So we need to account for that income. Now I have an account called Realized Gains, okay? That's an income account that I've set up with some help from my accountant. So you're just gonna wanna set something up, whatever you wanna call it, but you wanna separate out your income somehow. So you type that in there, it'll automatically calculate what you have left, and you can say what the income is from, all right? And then these balance out, and you're kind of all set. You're good to go. So you can go ahead and save and close, and everything should update, okay? And the most important things I'm looking for here is, did my assets zero out, okay? Did my loan zero out? Yes, okay? And then my checking account obviously increased with that check that I received, and my net income increased as well. Okay, so that's really how you do it. That's how you account for the sale. So you really want to mimic your closing statement. All right, and that really does it for this series on real estate accounting. Of course, there's different things that come up and different questions that everybody's going to have. So really happy to do some more ad hoc as we have questions and want to see different things happen within QuickBooks. But that should get you from purchase to rehab to sale of a property with a few different scenarios in there. So thanks a lot for watching. Of course, feel free to check out all the free resources available at incomedigs.com. Also, check out this YouTube channel. I'd really love it if you would subscribe, because we're going to be releasing a ton of awesome content in the near future. Until then, thanks for watching.